Welcome back to Chartbusters on CNBC-TV18. Now let's focus and put the spotlight on IKS Health. They reported their numbers, a 17% revenue growth on a year-on-year basis, driven by ramp-up in client additions as well as good margin improvement is what they've seen. Now talk to us about the numbers as well as the outlook of the company going forward. We have Sachin Gupta, who's the founder and CEO of the company, as well as Nithya Balasubramanian, the CFO of the company, joining you to talk to us about all of that. Sachin as well as Nithya, thank you so much and good morning to both of y'all. Before we dive into the numbers, just yesterday we had, more updates coming in on UnitedHealth, the issue on that front as well. I just want to understand what would be the impact of this on the company, any concerns that we're watching out for in FY26 on this front?
Good morning. First of all, thank you for having us today. Pleasure to be here. So yes, United Healthcare, look, I think obviously it's a company that's going through certain headwinds that are significant. As you know, they've been hit with three pretty dramatic events over the last 12 to 18 months. One of their biggest subsidiaries, Change Healthcare, had a big cybersecurity attack that almost destroyed them. The CEO of their insurance business was assassinated, and then a big part of their business, which is a Medicare Advantage business, is going through headwinds due to what is called HCC version 28. I will say that most other companies, if hit by such perfect storms, one after the other, would have collapsed. Now, keep in mind, United Healthcare is the largest health insurer in the world, certainly in the US, but in the world. They have nearly 50 million plus lives under insurance. So is the company under pressure? Yes. But is the company losing money? No. Is the company, does it need to transform certain things? Yes. Now, our relationship with United Healthcare is orchestrated through one of this $110 billion revenue company subsidiary called Optum Health, which employs 50,000 plus physicians. It's the largest employer of physicians in the world. And as you know, our business model is all built around driving operating efficiency in the non-discretionary spend for these physician businesses in the US. So in fact, what happens is when our customers come under pressure, we actually become often the relief valve that they need to get their performance where it needs to be. A testament to that has been that our relationship with United Healthcare has really grown at least 20 to 30% over the last 12 to 18 months. So actually, as much as it is unfortunate what United Healthcare is going through, I think there is no existential crisis to the business. And as they try to do things to get the financial performance of the business where it has been historically, we actually will be one of those contributors, we believe. And hence, without trying to get too speculative, I think we should be okay from a United Healthcare perspective. And I think United Healthcare as a business should be okay in the medium to long term.
Should be okay in the medium to long term, but how much of our revenue or any sort of impact that you could give us, how much revenue comes in from United Healthcare side right now?
Yeah, so we don't tend to reveal that, but suffice to say they are one of our largest customers. And again, really important to note that our revenue with them has been growing through this period of crisis. And actually, when we look at our opportunity set with them, it continues to reflect continued growth because it's very important to draw the distinction that a lot of what traditional IT services companies do with them is on the discretionary spend side. And in such crisis, discretionary spend gets cut. Whereas what we do with them is all non-discretionary operating spend, which we actually improve the cost on. And hence, our relationship with them in a tough situation is likely to experience growth versus deacceleration.
What I'm trying to understand is that, United Healthcare, which you're not revealing how much it contributes to your overall revenue. I see top 5 clients contributing about 22% to your revenue. Would suffice to say they're part of your top 5?
Absolutely.
All right. Nithya, Sachin did mention that regulation in healthcare will be your friend. Now that some regulatory announcements are beginning to come through, do you still hold that belief? What exactly is happening here? Because, day in, day out, you get headlines on social media, the President of the United States just putting out posts, changing, flipping, flopping. How do you navigate through that?
Specifics are still emerging, but I think if you look at it more from a fundamental perspective, what they're trying to achieve is reduction in healthcare costs. You'll actually note that healthcare spend in the US is $4.8 trillion, growing faster than GDP. So clearly they have to do something about making it a lot more sustainable in the future. So we believe that we are actually part of the solution. What we bring to the table are efficiencies and a platform through which these healthcare provider organizations can actually run their operations a lot more efficiently. So we genuinely believe that whatever be the specifics of the initiatives that the administration takes, given that the fundamental intent here is to make healthcare a lot more efficient, we continue to believe that this will be a tailwind given how our business model is structured.
So in light of that, with the kind of year that you've had, earlier it was alluded to as a perfect storm of sorts. You've still managed to grow 17% this quarter. For the entire year, it's been a much larger growth. As your base increases, what do you think would be a steady state growth that one should estimate for a company like yours over the next, say, 1 year, 3 years and 5 years? Nithya.
I think we have always maintained, and I will continue to maintain our guidance that we will, in the long run, be able to grow faster than the market. If you look at our addressable market, that's about $225 billion, expanding at 12%. And if you look at the underlying healthcare market, that's about $4.8 trillion, expanding at 5 to 6%. So we continue to believe that we will be able to grow faster than the market. Out of the TAM of $225 billion, only $34 billion is outsourced today. So there is clearly a lot of growth runway left. And given our business model, given our investments in technology, we will continue to grow faster than the 12%.
Okay, you will grow faster than the 12%. I just want to check in terms of the margins as well, right? Previously, we had spoken about the 30% range in terms of EBITDA margins. In Q4 FY25, we're clearly above that mark. Though full year FY25, it's 29% approximately. I want to know the outlook for margins in FY26. Are we going to be doing better than 30%? Would you increase your guidance for FY26?
I don't give guidance deliberately given the relative maturity, but we have been vocal in saying that we believe our margins will eventually stabilize somewhere in the early to mid 30s. And our 31.2% EBITDA that was delivered in Q4 FY25 is a fine reflection of our confidence in our ability to get there. So I feel like we have every reason to believe that we will get to that early to mid 30s range over the next 12 to 18 months. And without giving formal guidance, we continue to believe that that seems imminent.
And what kind of client wins are you expecting this year? You had two big ones last year. You didn't quantify the size, but if you could give us a sense of, the client wins that you're targeting this year, maybe potential size, because it's an interesting influx of both pharma and IT. Typically, IT companies give us these details.
Yeah, so, Mangalam, there is a deliberate reason why we haven't been giving the specifics, because the way our business works is often clients commit to a large contract, but the ramp up of the contract happens over a period of time. And different clients have different ramp up periods depending on which features of our platform they're implementing. And so what we tend to do is we announce clients that are full platform commitments. For example, this quarter, we have 3 customers that are full platform commitments. Skylakes is a big health system that's a full platform commitment. Platinum Derm is a full platinum commitment, which is one of the world's largest dermatology platforms. And a Western Washington Medical Group, a multi-specialty group, is a full platform commitment. Now, those tend to be larger in size because we are naturally committed to getting the full share of their wallet for those tasks. And then there are other customers that might be even larger in size, but they're committing to certain features of the platform. So suffice to say that, given where the buying behavior is and where it is still dynamic and not mature, it's hard for us to hazard exactly what the client revenue will be in 3, 6, 9, 12 months from now, which is why we continue to say, Mangalam, my simple thinking is, if the outsourced TAM is growing at 12%, if we grow faster than 12%, we are gaining market share. If we grow slower than 12%, we are losing market share. We feel confident based on our leadership that we will continue to gain market share, hence that faster than 12%. If the outsourced TAM starts growing at 15%, my suspicion is we'll grow faster than 15% as well. But how much faster than 12% becomes a little hard to predict in this currently dynamic buying deal.
Okay, Sachin, as well as Nithya, thank you so much for joining in with us on the show and giving us your time, explaining us what to watch out for on FY26 from the company. It's a pleasure having you both here. But